Hello, Ashwin.
Hi.
This is the place, this is the channel where I share with our viewers my conversations with you regarding wealth strategy and from your vast experience in the trading and investments business. We hope to glean from your know-how, your financial intel, so that our financial intelligence can also improve. And hopefully we can make some money.
Thank you so much for inviting me once again. Thank you so much. Today's video, it's a very important video. It's about the bond market.
Uh-oh.
Are slumping from the US to Australia this week as investors are back ditching sovereign bonds after rate hikes this week by the Reserve Bank of Australia and the Bank of Canada. Traders are now rethinking the possibility of rate cuts by the Fed later this year. They're rethinking that. Why? Because inflation remains stubbornly high. Now, short-term maturity US Treasury yields are close to their highest level since March, while Australian short-term bond yields have jumped to levels last seen more than a decade ago. Now, before I proceed further, let me just explain to you the golden rule. When bond yields go up, mean the price of the bond plunges, causing investors to lose money on their bond investments. That's how it works.
Yes.
It's
yes.
Okay. So
now I know why, Ashwin. Since March of 2022, you've restricted me. You told me not to get into bonds. You told me to stop buying bonds and any bond ETFs.
And I told you, I said you will see later on why.
Yeah, and I must tell viewers that in 2020, I made a 15% profit from a 20-year Treasury bond ETF before the rate hike started.
Yeah, because you have had the taste of what it is when the situation is normal. You can make money from bonds. But when the rate hike starts, you cannot make money from bonds. So if your banker had psychoed you to buy bonds when the rate hike started, I'm sorry for you.
But I'm glad I listened to you.
So, as I've been saying in our videos long time ago, that the Fed will not back off raising interest rates until inflation drops to 2%. Because Powell is like a dog who refuses to let go.
Yes.
He's been saying that. And inflation right now is still above 4%. So Powell will not let go. Okay. And
we have some ways to go.
And expectations for July now have shifted from an expected rate cut to an expected rate hike for the Fed. All eyes will be on US inflation data next week, which will provide further clues on the Fed's policy path. But let me smash your expectations. No matter what happens next week, inflation is not going to drop by 1% straight away. It's been dropping like 0.5, 0.4% every month, okay? Which is not fast enough. It's not good enough for the Fed, okay?
Yeah. So in this scenario of higher interest rates for longer and until inflation drops, what do you suggest we do, we investors? How can we, ride this tide and make some money?
Okay, the silver lining is this. In the midst of all this volatility and Fed argument about interest rates and other central banks raising interest rates, there is one big silver lining. The NASDAQ 100 cash index, which specializes in tech stocks, has been ignoring the inflation story and has climbed, listen to this, 34% since January this year. So you must see why. You must see why. Why? Because since January this year, NASDAQ has got a more powerful catalyst than inflation, and that is artificial intelligence. This shows you that people may say artificial intelligence is a hype, it will wear off like the metaverse, it will crash. No, I'm sorry. Let's put our mouth where our money is. This time, this AI is not a fad. It's real.
It's here to stay.
Yes, the NASDAQ has climbed 34%, and our clients have been making money because they bought the stocks through CFDs and only paid 20% upfront, and others they only paid 5% below. They paid 5% below market for the stocks at a 5% discount.
That's what I'm talking about, Ashwin. Whether or not we on our own can get a hold of these kinds of deals.
See,
5% below market,
you may get a hold of this kind
only
of deal.
upfront.
You may get a hold of this kind of deal from a banker, but you may not know what to buy and when to buy. That is the thing. So this is where we
and against what kind of backdrop and
correct.
for how
And
long to hold.
See, I must say this, I'm not boasting. When we pick a company, it is not because of our human intelligence. We have an algorithm that has been around for longer than ChatGPT, and that is called human quant. So when we have an algorithm assisting us, plus the human brain, plus our knowledge, it's a different ballgame altogether. You may turn around and say, myself, by all means, go ahead. We challenge you. We challenge you because
scary.
In this, since October last year, our clients have made 30% from 7 stocks. They have made 30% each. So you can see where we are heading. So after
I know every time you propose something, you always back it up with data like charts, like what you have behind you.
We do not trade on emotions. We do not trade on sentiments. We trade on facts. And we have the assistance of a super algorithm that is customized. Okay, so that's one thing.
Now I got to speed it up a little bit because we have limited time on the video.
So the second way to make money is a managed fund that trades FX volatility, meaning not market direction, volatility. And it pays you 8%.
That sounds scary. Volatility.
Yes, 8% a month, 2% a week. You say you're scared from volatility, but you have just made 11.18% over the last 5 weeks on this volatility. So
really,
2% is the base case per week. Okay, and a third way is a staking fund that does not trade but gives you 1% per month, which comes to 0.25% a week. So you can see from here, until you wait for the stock market to go up when you buy the quality tech stocks, you are making a recurring passive income of 2.25% per week at least.
So quality stocks, managed fund, and staking fund, all in all side by side.
Yes. So I say this to bond buyers. Isn't this better than buying a bond where you see your bond value dropping because of interest rate hikes? This is the way.
And the worst part is the lockup period is long, like a year, 5 years. Some of them
for a bond can range between 1 year and 5 years. It depends on your bank. Depends on what you buy. So
and the staking fund and the managed fund, how long?
Managed fund, you can take out the money every week.
Wow.
Okay. Your active income, you can take out the money between 3 and 6 months. Okay.
Nice.
Okay? So
how do we call you, Ashwin?
We can be
reached. We wanted to ask you questions.
Yes, we can be reached at bit.ly/algotrader, which will bring you to our WhatsApp page because our website algomasters.com is under construction, and we can answer all your questions. So you
think it's worth a call.
I repeat this: bond buyers, you have been used to buying bonds because somehow your bank, I'm sorry to say this, has psychoed you that bonds are safe. Let me tell you, in the interest rate rising,
that's the policy, right?
In this rising interest rate environment, bonds are no longer safe. I don't care what your bank says. And we'll prove to you, we'll prove to you if you give us a call that we have a better system.
Right. Thank you so much, Ashwin. I think it's good that we personalize our portfolios and talk to you about our concerns. Thank you so much for today. We'll be back.
Thank you, Ash. Thank you, Tessie. Thank you.